This is a call to order the regular meeting of the Personnel, Pension, and Insurance Committee of the MDC, Monday, May 20th, 2024. Mr. Secretary, do we have a quorum?
Yes, we do.
All right. Are there any public comments relative to agenda items? Once again, are there any public comments relative to agenda items? There being none, we move to item 3, approval of the meeting minutes of April 29th, 2024. Do I have,
Motion to approve. Second.
right, are there any amendments, comments, additions, deletions? It's been moved and seconded. All those in favor?
Aye.
Aye.
Opposed? Are there any abstentions?
Abstained. I wasn't present.
We move to item 4, a report by DeHaab Associates. Mr. Lee, as always, it's good to see you.
Great, thank you all. Good to see you as well. Good afternoon, everybody. I believe hard copies of the report might be on the table. And for those of you that I did get to see a couple minutes before the meeting, I did hand out another single sheet as well. We have extra copies of that single sheet on the table also. So what I'm going to do, if okay, is we'll start off with the pension book. And if I could ask us to look at page 4. So on page 4, what you'll see is in the upper left-hand corner of the page, at a high level are some statistics about the economy. And if you look at those two columns, the left column is the current quarter, the right column is the previous quarter. The numbers are nearly identical. The only gap that you really have is in GDP. So for the current quarter, the GDP is about 1.6% on an annualized basis, while the prior quarter is 3.4%. Really, the gap is primarily because we had more imports. And as you all know, for GDP, part of the calculation, imports is actually a -2 growth GDP calculation. It just actually means positively that we're spending a lot of money, which as American consumers, as you all know, that represents about 2/3 of the economy. So although it's good for the overall economy in terms of spending, it actually is a negative when you look at GDP. Unemployment also ticked up after this to, I think, 3.9%. But the takeaway here is that unemployment now is south of 4% on an annualized basis for almost a year. So it's very good overall in that perspective. Also, CPI, which is a reflection of inflation, as you all know, remains tepid. So all of these are good constants that we've seen from the prior quarter. In fact, because of that, the last quarter, which is January, February, March, was a very good stock market. If you look in the upper right-hand corner of the page, I typically focus on the S&P 500 because that captures primarily large cap stocks. And you see for the most recent quarter, the S&P 500 returned 10.6%. And that brought the 12-month return almost to 30%. As a reminder, when you look at trailing periods for the S&P 500, you look at 20 years, 50 years, et cetera, generally speaking, the annualized number on the S&P 500 is about 10% for a full year, and we got that in one quarter. So the first quarter of 2024 was actually quite robust. We outperformed international markets. As you see, the MSCI EAFE and the MSCI emerging markets represents developed and less developed markets outside the US. They were up 5.9%, 2.4% respectively. The places that were down were the quote-unquote safety assets, actually. So the NCREIF Odyssey, which represents real estate, that was off 2.4%, bringing the 12-month return to a -11, while bonds even lost. They were fractionally down for the quarter, bringing the 12-month return up to only 1.7%. The last thing I'll highlight here on this page is bottom left-hand corner of the page. Really, it has been a consistent trend in the types of stocks that have done well. So when you look at that square in the bottom left-hand corner, you see it's growth, core, and value, and then large cap, mid cap, and small cap. And you could simply draw a line from the bottom right straight up to the upper left, because if it's growth-oriented and large cap, that did quite well. So growth outperformed core, outperformed value. Large cap did better than mid cap, did better than small cap. So for the past quarter, it still has been a very technology-oriented marketplace, and that trend remained true also for the trailing 12 months. Flipping a couple pages forward to page 9. And this is a snapshot of the portfolio over different trailing periods. And going down that first column, just to highlight for you, for the most recent quarter, in one quarter, the fund gained 6.1%, which is a very nice return. In fact, that outperformed both the shadow index and the policy index. As a reminder, the shadow index and policy index are two ways of looking at the portfolio if we had everything just in index funds. So put the portfolio in the 6th percentile, and as you recall, the lower the number, the better. So it beat roughly over 90% of the funds out there. And when you go down that column, you notice that large cap met the benchmark, which you would expect because we're indexed there, as well as mid cap. We have an index fund there, so those both match the benchmarks. Small cap is an active manager at 5.8 versus 5.2, outperforming. International active manager, 6.8 versus 5.9, outperforming. Real estate, by losing less, we outperformed, lost 2.2 versus Bogia down 2.4. Timber outperformed at 2.4 versus 2.1, and bonds outperformed 0.3 versus a negative 0.8. So this is actually quite an exceptional quarter because every piece of the portfolio outperformed. Usually we don't see that. Sometimes we have pieces go zigging while the others zag, but hopefully the combination does well. To that point, if you look at the longer-term numbers, trailing 3 years, the fund gained 4.7% in the 46th percentile, 5 years, 8.3%, 38th percentile. For the past decade, the portfolio generated 8.4% annualized in the top decile, in the 6%. Asset allocation in the upper right-hand corner of the page, you see that roughly about a third of the portfolio was large-cap stocks. When you add up the mid-cap and small-cap, that's another 25%. International, about 13%. And the rest, which is about 30%, representing more of our safety assets, real estate, timber, domestic fixed income, and cash, it's about 30%. So roughly 70-30, if you will. The other thing I usually touch on this slide is just to remind ourselves that, remember, real estate and timber for us are the two asset classes that we use as proxies for bonds, meaning that hopefully they have similar volatility like bonds, but do better over the long term. And in fact, when you look at the 3-year and 5-year numbers for real estate and timber, real estate is 3.4 and 4.4 respectively. Timber is 8.4 and 3.6 respectively, while bonds were 0.6 and 2.8. So it has been a good trade to put some of our assets into the less liquid investments that look similar to bonds, but hopefully gave us more return. Bottom right-hand corner of the page, you see the portfolio was at $247 million at the beginning of the period, which is frankly the end of the calendar year from last year, and we rose to $266 million by the end of the quarter. It may be a good time for those of you who can refer to the single sheet handout. This is a market value as of last Friday. It's preliminary, but what's pretty ironic is that you see that as of last Friday, the market value is almost smack on top of what we were at the end of March. So as of Friday, the market value is roughly $265 million, $266 million. As you all know, April was a very bad month for the markets. May has done quite well, which is kind of why we've treaded water since the end of March relative to where we sit today. The other page I'll touch on, or a couple slides actually, page 11 in the pension book. And this is a page that you all are very familiar with, but the reason why I like it is because in one snapshot in the picture, you really can see how the pension fund has performed for roughly 2 decades. That dark line, as you know, again, is the corpus of the fund, which over time has appreciated. It's not a smooth ride. We would not expect it, but it has been ascending over the long term. The dotted line underneath is the assumption rate. So over this period, had we hit the assumption rate, our value would be at that level, which is roughly about $40 million shy of where we are, at least for the past couple of decades. And then the dotted line on the bottom going into the x-axis is the cash flow line. So the way you read the numbers on the bottom right-hand corner says that in this past 20 years or so, the portfolio value was started at 121 million. We've taken out 138 million, but we've made 283 million. So we've made more than double what the beginning market value has been since this period. So good, steady returns over the long term. Next page is page 12. And this just decomposes what we saw a moment ago on page 9, because it puts names to the components that are individual line items, like large cap equity is an index fund with Fidelity, mid cap equity is an index fund with Rumline. So all those numbers are identical in black and blue. The next one is Wellington, which is an active small cap manager who has done a nice job outperforming the benchmark. You'll see that for the most recent quarter, they beat the benchmark by 0.6%. But I think more impactful is if you look over the longer term, 5 years, 10 years, they beat the benchmark 11.8 versus 8.1, and 10 years, 11% versus 7.6. So that's an annualized return. Hardman Johnston outperformed for the quarter. Over the 5 years, they're actually a little bit behind the benchmark, but they're doing a little bit better now. And then we have 4 bites at the apple with real estate. We have Cornerstone, Intercontinental, Madison 3, Madison 5. As you all know, Cornerstone is one that pops out at you because of those huge negative numbers. But I have to remind you, we have less than $10,000 in Cornerstone. I mean, relative to a portfolio that is $266 million, that doesn't really move the needle. But unfortunately, because we still have some money in that as it continues to wind down this year, it gets equal billing, at least on this page. So it just kind of stands out. But in terms of the impact to the portfolio, it's de minimis. FIA is our timber manager. And then with fixed income, we have 2 bites at the apple. We have Goodwin and Aetna. Aetna is really more of a steady Eddie because it's kind of a guaranteed contract, while Goodwin is an active bond manager who tries to outperform the benchmark. And they did so in the most recent quarter by losing less, and for the trailing 5 years by beating the benchmark, more than doubling the return of the benchmark. The last piece I'll touch on is the asset allocation, page 8. And this just is to remind us what the target asset allocation is and how the asset allocation actually was. So the right-hand column shows the target, and then the percent column shows the actual. So you'll see that we were a little bit over-allocated in large cap, mid cap, small cap stocks, as expected, because those are the pieces that did quite well. And the place that we were most under-allocated, frankly, is in bonds. The single sheet that I handed out that was as of May 17th, numbers didn't change that much. You'll notice that that trend remained true. So mostly slightly over-allocated on all of the equity pieces and then under-allocated on the quote-unquote more safety assets. So I know I went through that at a pretty good pace, but I'm happy to address any questions that you might have on the economy or the portfolio as of the end of the quarter or any of the managers.
Does anyone have any questions? Yes.
A little bit of an odd question, but you're up 20 million. Is it worth just getting out for the rest of the year? That's not the type of thing that you...
Yeah, unfortunately, it's not the type of thing that we can do. But what we will do is when it makes sense to pull cash, we will pull it from large cap stocks because obviously, honestly, I would not have guessed that May would have been so robust. At the beginning of the year, it was kind of looking more glum. It looked like we would actually go into a recession, but all the numbers are starting to look solid. And now it doesn't look like we're going to go into a recession this year. But that's not to say that it's smooth riding at all. I think that it's pretty likely that we will have some continued volatility. Having said that, the S&P 500 and the NASDAQ are hitting all-time highs again today. But to your point, we will take cash from stocks and put it on the sidelines. Yes?
David, can you give us kind of quick and dirty view in terms of real estate, where that market is going? I mean, there's the commercial component, then there's the residential commercial seems to be sort of in a flux right now, given the fact that people are working from home and companies are trying to decide what their footprint is going to be
Sure.
relative to their real estate holdings for offices and things like that.
Right.
And then there's a tremendous squeeze in the real estate market. What's your take on that?
So, as you know, the basic real estate market, when you look at institutional level type of investing that we all do, 4 basic food groups: apartments, industrials, office, and retail. The biggest exposure for most managers now has moved over into apartments and industrial because office, frankly, is doing quite poorly. Obviously, since COVID, valuations have come down tremendously. In fact, valuations are down in that segment for about 50%. However, both in apartments and industrials have made that up. They've gone up quite high. Some of the less represented property types would be medical offices as well as self-storage, hotels. Those have a little bit less representation in institutional real estate. But when we talk with real estate managers, what they're all kind of saying now is that 2024 really looks like the turn in the marketplace, where it seems like whenever they are looking to either buy a building or sell a building, they're definitely getting more interest on both sides. Even last year, interest may have been a little bit more unusual because you might have had perhaps high net worth clients or different investors, i.e. alternative managers, whether it's a hedge fund or private equity person come in. Now it seems more traditional types of other real estate managers are bidding on properties. So it seems like the market in real estate is starting to wash out some of the underpriced buildings. The place that are still going to be somewhat stagnant, though, is going to be, of course, office. In our portfolio, fortunately for us, roughly about half of our representation actually is in real estate debt. So yes, technically, if there are problems with the underlying building, we could have problems. But for us, the Madison 3 and Madison 5 products are just loaning money to developers, and those have an interest rate associated with them, and they're just loans that they get paid back on. So they've been doing quite nicely. Intercontinental has roughly about 20% of the portfolio in office, but the majority, roughly about 60-65%, is going to be in apartments and industrials. So we are protected as much as we can in real estate with our property distribution and the type of investments that we have with real estate. So real estate goes through cycles. It seems like we're coming through the worst of it for this year, and probably tail end of 2024, and then going into 2025 will be a better period for real estate.
Thank you. Any other questions for David? If not, why don't we go to OPEB?
Great, thank you. So the OPEB book is a little bit easier just because the asset allocation is a little bit more straightforward. So in the book, what I would say is if we could go to page 6, and on page 6 of the OPEB book, which is a thinner version of the same book that you just saw a moment ago for the pension book. And here, the performance has been quite robust, and it simply really comes down to asset allocation, right? Because roughly 75% of the money here is in stocks, and about 25 roughly is in non-stocks, whether it's in bonds or in cash. So for the quarter, the fund gained 5.8%, which is in the 10th percentile. And for the trailing 3 years, 5.1% in the 29th percentile. Here, as you recall, the bulk of our assets are indexed, but we do have some active manager as well. But overall, the portfolio is done quite nicely. Bottom right-hand corner of the page, you'll see that we started off at $11.6 million. Really, the big piece that moved the asset value is that we did have a contribution. We brought all the assets over into the OPEB pension trust, so that now we're looking at roughly $19 million in the OPEB. Next page is the asset allocation. Oh, I'm sorry. By the way, as of Friday, the portfolio value, I'm showing 17.7. The reason why I'm pausing is because that obviously is off from what we're seeing here. So yes, some cash was taken off, which is why we're seeing that differential. You'll see that there is a difference in cash. Some cash was put into different accounts, still part of the OPEB, but not part of the OPEB that we're actually managing. The cash difference you'll see is 1.6 for the May value versus the 3.1 value that we see at the end of March. Page 8. Really, there isn't too much to see here because the OPEB has only been structured into more of an active structure within the past few years. That's why you see kind of that hockey stick as we started putting the money away from just cash into the marketplace. It did appreciate nicely. So that's what you would have expected with the asset allocation that we have. Next page, page 9. The reason why we have only 2 lines on page 9, the total line and the total bond market line, is because, frankly, we moved most of the money from all the pieces that were just in Vanguard large cap into Fidelity index funds because they were cheaper. So you could see that actually on page 10. So page 10, you'll see that we got rid of the Vanguard large cap, and then we put the money across into different Fidelity index funds. So the Fidelity large cap index fund, Fidelity mid cap index fund, the small cap index fund, global index fund, and then there is a Vanguard bond fund. So this portfolio is pretty straightforward. There's nothing really complicated about it, and it's a cheap access, diversified portfolio. But the asset allocation is a little bit more aggressive. It makes sense on the OPEB plan. It's worked because, frankly, stock market has done well, and we've participated fully in the stock market in this plan. So officially, no recommendations for any changes on the asset allocation for either the OPEB or the pension plan. We're comfortable with both of them. We're not recommending any manager changes either. But happy to address any questions on the OPEB as well.
Are there any questions? I just have one for you very quickly, David. Since the OPEB strategy is, I would characterize as being aggressive,
Yes.
what defensive posture does one adopt in that situation, if at all? Because essentially, we're really rolling with the large cap market.
Yes. I would say with a plan that has such a modest amount of assets relative to your liability and relative to the amount of capital you're going to be putting into the plan anyway, the amount of conservatism that you introduce to the plan is really going to be de minimis because your liability is so big. Even if you make this a little bit more conservative, you're not going to move the needle that much. The only way you move the needle a little bit is by being a lot more aggressive in this plan. The biggest thing that we got by creating this asset allocation is, number one, we were able to get an assumption rate on the OPEB to a 6.25 versus what would have been probably somewhere in the neighborhood of like a 2% or a 3% type of number, which means that your liability would have been a lot higher. That's something that the actuary determines. But because we have a viable asset allocation, we were able to, or the actuary then was able to feel comfortable assigning an assumption rate of 6.25. Our asset allocation, frankly, is more aggressive than what we would get for 6.25, but I think it's reasonable considering that the pool of money that we have is so modest relative to the liability, and also knowing that there is a backstop, meaning that before this had happened, most of everything in terms of the OPEB was pay-go anyway. So we're saving a little bit by putting money in this asset allocation to hopefully gain more returns and still have a lot more backstopped, if you will, by MDC for that liability.
Thank you. Any other questions for David? Thank you, David.
Great.
As
Thank you all
always.
for your time. Appreciate it.
Thank you. If there are no questions for David, either here or for those people who have wired in, we will move to item 5, consideration of potential action with regard to job specifications.
Good evening, Commissioners. This is Jamie Harlow, Director of HR. Here once again to talk about some job descriptions along the same lines of what I've been here for in the past, looking a lot at multitasking and succession planning. So item number 5 was amendments to currently existing job descriptions within the finance area. So everyone received the job specs, noting where the changes were. Again, some of them on the duties and responsibilities to make sure we are, as best as we can, reflecting the assigned tasks. And then also making sure we have some of the common language, like job descriptions and things like that. So that the 3 positions are amending the current manager of budgeting and analysis to assistant manager. That would retain the salary grade of a EE 18. The manager of treasury and the controller also, again, retaining those job titles, but changing those to 20s, which are very similar to what we've done in other areas, such as engineering. So I don't know if there are any specific questions related to these 3 job specs.
The changes, do those also reflect a change in the salary range or not? Has that been moved up or down, or remains the same, or what?
Yes, all 3 of, actually, the assistant manager of budgeting and analysis. We currently have a manager of budgeting and analysis, and in looking at updating these job specs, it's a great opportunity to kind of look at reorganizing, restructuring to kind of have a format that will help sustain those organizations. And the decision was made that, the budgeting area is a fairly small area, which does interact under the director of finance. So the suggestion was to make that an assistant manager of budgeting and analysis, which would be but retain the same salary grade. The duties really roughly remain the same. Again, similar to what we've done in other areas where we've introduced that assistant manager level to provide also opportunity for growth within that area. And then the other 2, the manager of treasury and the controller, we are recommending, in addition to the update to the job specs, update to the salary ranges to EE 20 from EE 18s. Again, similar to what we've done in other areas for manager level positions.
Have we benchmarked these at all to people on the outside?
Yes.
Either the private sector or comparable jobs in comparable institutions, and where do we fall, if at all?
Yeah, so I looked at salary.com, and we do have, we're kind of right along the range that the benchmarking. Some of those are kind of wide ranges, so I'll give an example. The controller, I believe, the median was about 167, but the low point was about 128 up to about 212. So if you look at the job specs that were included in the packet, the controller comes in, it's right within that range. So the controller that we're suggesting is 144 to 201. So essentially lower than the high point, but higher than the low point.
Do we do a,
And the median was 167. We're suggesting the starting point be 144.
now, do we do an analysis in terms of sensitivity, in terms of looking at the impact with regard to the pension? Do we ever just run some scenarios to see what kind of liabilities we're building up?
No, I have not done any such analysis.
Okay. All right. Yes.
Yeah, I'm just curious, what motivated you to even do this, these 3 changes? It just seems to me it's, we're fixing something that's not necessarily broken. I don't know, was something broken while we did this for these 3 positions? I mean, it's not new positions. It seems like everybody's gonna have the same job when they're done, and maybe a different title or something. I don't know. It just seems like,
Mr. Chairman.
yeah.
Yeah, so succession planning. So, as you know, we've brought to this committee and the full board, a lot of our manager positions were E&E 18 is kind of consistent across the board. Over the years, and I'm talking about early 2000s, late 2000s, we've elevated the manager position to a 20 in operations, but we hadn't done it in this office, like engineering or in finance. We recently brought to this committee the engineering positions that were 18s. We brought them to you for 20s. It's a parity issue. It's a responsibility. It also brings the ability to develop succession planning. So finance has never had an assistant manager position. We've always had assistant manager positions in operations. It was sporadic through engineering over the years, but we're trying to build succession planning, and the best opportunity to build succession planning is for an assistant manager. And you have to worry about, you just don't worry about the outside market. You have to worry about the inside market at the MDC. Where are positions? And I can't have an assistant manager that's an 18 and have a manager that's an 18. So almost everybody that you see and talk to at the MDC is working harder, more with less. And we believe that the finance department should have an E&E 20 position, and they should also have assistant manager positions for succession planning.
Are there in finance 18 still? Or
Yeah,
all the
so we're
18's going to 20.
well, we're proposing in these two agenda items is we had 3 manager positions at 18s.
Right.
We're proposing to make one of the managers a 20 and have 2 assistant managers under that position. And then the other manager position will be raised to a 20, and that will have an assistant manager as well. And so we're creating that succession for, really for our internal staff to, a lot of times we have here at the MDC, we have, I'll use E&E 18 as a manager or an assistant manager, and you have an E&E 14 that's an administrator. It's highly technical, requires a 4-year degree and others requirements, but there's no supervision. So it gives, an assistant manager gives that person at that E&E 14 level an opportunity to get that supervisory experience to become, our future leaders. And that's really what's happening in finance as we speak. Also, it's happening in engineering and construction as well.
Anyone else? Mr. Curry?
Thank you, Mr. Chairman. Through you, Jamie, and I've been away from the state for like 13, 14 years, but they used to have a process where you were reclassed depending on your length of service, which would dictate what your salary might be if it was a bargaining unit position. They were awarded either whatever that reclass would give them or 5%, whichever is greater. Do we have any such program here in MDC?
We don't have any programs that are specifically tied to the base compensation. We do have longevity for all of our union positions and our exempt and excluded groups, so they get lump sums throughout the year based on their years of service, but it's not tied specifically to the job they're in.
Thank you.
Anyone else? Okay, we can move to item 6.
We need action.
Okay.
Well, okay.
Okay, thank you.
Well, I
sorry.
thought that we consider them both and then just vote on them together. Can we do that or not?
For both 5 and 6, it's 3 separate
Yes,
actions.
yes.
But if somebody wants to consolidate them, then you can do a singular vote.
Does anyone have any objection? I would like to consolidate 5 and 6.
Mr.
So-
Chairman, I would object only under the rationale that 6 is amendments and 5 is amendments and 6 are creation of
Okay,
job specs. So I would like to keep them separate.
all right. So that being the case, we have to move on item 5. Do I have a motion?
So moved.
Second.
All those in favor?
Aye.
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 Opposed? Passes. Okay, now we can move to item 6.
Okay, thank you, Commissioners. Item 6, Scott already touched on some of this, but these are the creation of 3 new job specifications, 2 for finance, 1 for human resources. The 2 in finance, again, are to create that parity across the different organizations and those assistant level opportunities to help with that succession planning. The third one being for HR is that same concept. The majority of the staff I have in my office are HR generalists, and then we have a manager. So there's not really any succession planning at this point that is available because we're not going to have an office full of managers. So looking to really kind of build that succession planning there, as well as, HR is changing, whereas other organizations, I feel like, finance may bounce around to different financial units. HR is kind of in its own little bubble where HR people generally stay in HR. So I don't know, again, if there are any specific questions, but the assistant manager positions are proposed at an EE 18 level, and the HR position is proposed at an EE 15.
So these are new positions, these 3.
Yes, correct.
Are we going to get rid of 3 positions? I mean, there's no new work taking place, is there?
Oh, yes, there's a lot of new work
So
taking
who's doing-
place.
okay,
Scott
but
Jellison.
So who's doing the work before?
Well, so remember, as I suggested, that right now you have a big gap between an employee at a high skill level. I'm talking about someone with a degree, 4-year degree, master's degree, but no supervision experience. And all of our manager jobs require, or assistant manager requires some form of supervision. So this assistant manager positions we may not fill these jobs right away. One thing that we have done, this is a structure, right? We're trying to build a structure. And one thing that we have done on numerous occasions is the MDC has a lot of young talent at the within our organization. We have tried on numerous occasions to fill these jobs from the outside with no success. The challenge was our young people don't have the experience to qualify for that manager job. So what we have done in a lot of specific cases is held these positions and not advertise them to give our employees an opportunity to grow within their department. And so this assistant manager job just gives that stepping stone for an internal employee that can move up and then eventually hopefully be the manager someday. So we may not be filling all of these right away, Commissioner, but it's providing us with the structure for succession planning within our organization.
Okay, I kind of get you, and I'm not going to question, but
Yeah.
just seems to me we're going to have a new spot for 3 new people, but all this work is being done now, unless there's all these overworked. I understand what you're saying. You're trying to find a spot the guy to move up. If the guy moves up, does this job go away? The lower job?
What I would suggest to you, Commissioner, through you, Mr. Chair, I'm going to ask you for 10 positions next year because everybody's working so much harder. The North Hartford project, like I said, I've said this 1,000 times. We went from 47 million to 180 million. Our people are working very, very hard, and we need succession, and we need more people.
A better answer than your first.
Sorry.
Okay, thanks.
Anyone else? I guess one of my concerns in all of this, and I guess it's more on a general level, is I'm not a believer in this whole notion that people, because they're good in a particular job, that they'll make good managers. And I think that good managers are developed or are created. And I guess I would caution us to be thoughtful about that process, not doing someone a disservice who may be a very excellent technician, but their only opportunity basically to increase their livelihood is to be promoted into a managerial position, and that may be disastrous. I'm not saying that that is the case now, but I think that the research has shown that this is really a problem that you have to really contend with on the HR level. And I think that we need to be thoughtful about that if we have people that are really good, they're solid technicians, know what they're doing, that there's the opportunity for them to become managers if they so desire, but more importantly, if they want to stay as a technician, that we don't penalize them. So that's just a thought on my part. But other than that, are there any, Mr. Curry?
Thank you, Mr. Chair. And I would just like to piggyback on what you said, and the perfect example was with the state. We had promoted, well, another agency promoted one of our managers, and off he went, and he was great at what he was doing. He went to the other agency, and just by chance, we were also interviewing and filling the same position that he'd vacated. And the timing was such, he was gone, and the next day we filled it. And after about a month at the other agency, he wasn't working out, he wasn't happy, they weren't happy with him, he wanted to come back. And we would have taken him back because he was doing a great job in the position with us. We couldn't take him back because we didn't have a vacant position. So I would only caution as we move through and we start these upward mobility promotional opportunities to keep that in mind and don't be so quick to fill a new vacant position created by this move, that's all. Because you may want to go back.
Yeah, absolutely.
Anyone else? Then we have to have action on these three positions. Do I have an appropriate motion?
So moved?
Second.
All those in favor?
Aye.
Opposed? Passes, all right. Item 7, just a quick report on where we stand currently.
Good evening, Commissioners. Kelly Shane, Chief Administrative Officer. I just wanted to give you an update or a report on the RFI for the technology for the climate survey. So after our discussion at our last meeting, we were able to post the RFI that same week. It was posted Friday, May 3rd. We had a receipt of questions due date by Friday, May 17th, which was this past Friday. We did not receive any questions. However, we have had 17 firms download the RFI. Actually, 16 firms downloaded the RFI. We are talking to another firm who is planning to download that RFI. About 11 or 12 of those firms are all involved in this workspace. Some are software firms, some are consultant firms. So we do anticipate that we will receive adequate number of responses. The due date for responses are Tuesday, June 4th, which would be just about 1 full month. And that's at 4 p.m. on Tuesday, June 4th. So by the next meeting, or prior to the next meeting, we will have the responses and we will be able to put together something for you by the next PP&I meeting.
Any questions? This is not an action item. So we can move on to item 8.
Good evening, Commissioners. Jamie Harlow again. Item number 8 is the request for data specific to our retirements, resignations, and terminations for the prior month, which would be April of 2024. We had a total of 3 retirements in April. We had 1 African-American male from our local 3713 bargaining unit who had 36 years of experience here. We had also, in addition to that, 2 white males, also from 3713. One had 33 years and one had 25 years. And that concludes the report on retirements, resignations, and terminations.
Thank you. Any questions? Thank you very much.
Thank you.
Item 9, opportunity for general public comments. Once again, opportunity for general public comments. There being none. Item 10, Commissioner request for future agenda items. There being none, I will entertain the appropriate motion.
So moved. Or did we lose?